Welcome to RBC's Markets in Motion podcast, recorded November 24th, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, with the S&P 500 having finally entered what we consider to be a garden variety pullback on Thursday, we review what we're watching to help us gauge if and when it's run its course. Second, with old leadership in U.S. equities under pressure, we review which trades are working best right now or might be starting to work among the data sets we track regularly. And third, we review what we learned from the consumer companies that reported over the past week. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one, what we're watching to help us gauge if and when the pullback has run its course. On Thursday, the S&P 500 ended the day 5.1% below its late October high, officially entering into what we consider to be a Tier 1 garden variety pullback on our Tiers of Fear framework. This is something we think has been long overdue for a number of reasons, despite our constructive view on the year ahead. The list of things we're watching to gauge if and when the pullback is done is way too long to dig into in this podcast. A few that are top of mind are here. To start with, valuations. FY2 PEs for the S&P 500, the top 10 market cap names in the index, and the NASDAQ 100 have been unable to expand since the late summer, essentially bumping up against the peaks or ceilings established pre- and post-COVID. As we look across these indicators today, we see slight but not substantial improvement. There's no magic number valuations need to go to before markets can find their footing again, and it's possible they'll simply remain stuck around current levels until a new year of earnings forecasts cycle in. But if the pullback persists, these charts will be helpful in identifying the moment in which bargain hunters might get tempted back. There's been more progress, admittedly, on valuations in small caps, where the Russell 2000 market cap weighted FY2 PE has fallen from the 16.5 to 16.9 times area that it's been hovering around recently to about 15.8 times in our latest update. Moves to average often end up being an important line that isn't crossed. Meanwhile, Bitcoin needs to start behaving better. The choppy trends in Bitcoin since the summer have been something we've interpreted as a sign of fatigue among retail investors. We and other stock market watchers have highlighted how Bitcoin's been positively correlated with the S&P 500 and other major indices in recent years. While it's not clear to us exactly what's causing Bitcoin to drop, stabilization in this corner of financial markets would likely help to calm some nerves in U.S. equities as well. Separately, bulls have already pulled back on the AAII survey quite a bit. We included the recent deterioration in net bulls on the weekly AAII survey, which stands for American Association of Individual Investors, on our list of things worrying us about the stock market in the near term, mostly because it's unusual to see net bulls fall without a noteworthy dip in the market. It's important to take note, though, of how far sentiment has already fallen on this gauge. Net bulls have already fallen back down to levels that marked the low in August and September, and the 4-week average is at a level that tends to be followed by a 10.8% forward return in the S&P 500 on a 12-month forward basis. That being said, this indicator is not yet back down to the more extreme lows of 2022 and early 2025. This indicator captures how we feel about the pullback generally. It's possible the decline in net bulls has more room to go, but for longer-term investors, it's already on the list of intriguing data points. And finally, on the pullback, stocks have been fed up. In recent years, the S&P 500 often rises when Fed cut expectations are dialed up and comes under pressure when Fed cut expectations are dialed down or hikes get baked in. After Friday's strong rebound, it was not surprising to us to see that Fed cut expectations had improved a bit. We'll wrap up the pullback topic with a little bit of historical context. When recession fears or systemic issues are off the table, pullbacks tend to be limited to the 5 to 10% range. A 10% move off the late October high would take the index to roughly 6,200, but it's worth noting there have been several periods of stress that felt rather intense in the post-COVID era that have not seen stocks hit that threshold, such as the Japanese carry trade unwind of August 2024 and late 2024, early 25 profit taking. Let's move on to takeaway number one, what's working or starting to work. At the index level, value's been beating growth, and that persisted Friday. Small hasn't been beating large for the most part recently, but actually did so on Friday. Unlike what we saw in early October, the Russell 2000's leadership was not driven by the outperformance of quantum names that had become big weights in the index, a sign it may be more of a real shift. Sector-wise, within the S&P 500, healthcare, staples, and energy have been the top performing sectors since late October. These three sectors appear to have some of the most attractive valuation profiles in the S&P, but healthcare is the only one of the three that has been seeing positive earnings and revenue trends in recent months. One of the reasons why we've been highlighting it as our preferred defensive in a broader market drawdown. And energy and healthcare have also been both seeing strong inflows. Finally, the market has been flipping to safer factors. Within both the Russell 2000 and S&P 500, high earnings quality, low vol, low price momentum, and high dividend yield are all starting to outperform, a sharp reversal in leadership. And we'll wrap up quickly with takeaway number 3, insights from last week's consumer earnings. Overall, companies highlighted a mixed macro backdrop, ongoing and intense consumer challenges, and their ability to manage through tariffs. One of our takeaways that felt a bit more incremental was the conversation on inventories. Some companies highlighted how they're strategically managing their levels. Several retailers appear to have intentionally built up their inventories ahead of holiday or otherwise discussed their inventory levels being in good shape. Additionally, on AI, examples and stats on end uses and impacts seemed more specific than the past. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.